Assalamu alaikum wa rahmatullahi wa barakatuh. All praise is due to Allah, Lord of the worlds, who revealed Islam as a complete way of life, encompassing all aspects of human conduct including commerce and financial transactions. May peace and blessings be upon our noble Prophet Muhammad, peace be upon him, his family, his companions, and all those who follow in his footsteps until the end of time. Narrative: Payment cards in Islamic finance, based on AAOIFI Shariah Standard Number 61. In the modern financial landscape, payment cards have become a vital tool for daily transactions. However, within the context of Islamic finance, a significant question arises. Are payment card systems compatible with Sharia principles? To address this challenge, the AAOIFI Sharia Board developed Sharia Standard No. 61, which comprehensively discusses Sharia regulations related to payment cards. This standard updates the previous Standard No. 2, issued in 2000, and has been restructured to reflect industry developments and the latest fiqh considerations. The standard governs all forms of payment cards issued by Islamic financial institutions to customers, including both primary and supplementary cards. Its purpose is to facilitate cash withdrawals, payments for goods and services, or to serve as a guarantee for future payments. The scope covers four main types of cards: debit cards, prepaid cards, non-revolving credit cards, charge cards, and revolving credit cards. A debit card is a payment tool directly linked to the cardholder's account balance. It is not a credit instrument, and its use is limited to the available funds. In contrast, a prepaid card does not require a bank account. The customer deposits a certain amount and receives a card to use until the balance is depleted. Meanwhile, both forms of credit cards involve the provision of credit by the card issuer. Non-revolving credit cards require full payment by the due date, while revolving credit cards allow for minimum payments and gradual settlement, which in conventional practice often involves interest. To ensure compliance with Sharia principles, AAOIFI outlines the characteristics and relationships among the parties involved in card transactions. The five main parties are the card issuer, usually a bank, the cardholder, customer, the merchant, the acquirer, merchant's bank, and the card network, such as Visa or MasterCard. The relationship between issuer and cardholder involves two stages: card issuance as a service, khadamat, and card usage, which involves direct payment from the customer's balance or from the issuer's funds, which becomes a debt for the cardholder. If the card is used solely as a guarantee, its role is limited to acting as a payment guarantor. Card issuers are prohibited from charging interest on late payments, as is common in conventional cards. If the institution requires cash collateral, customers must be given the option to place these funds in an investment account, not just a current account. AAOIFI also prohibits the issuance of revolving credit cards with compounding interest schemes, as this clearly contravenes the prohibition of riba. Furthermore, AAOIFI emphasizes that all fees charged to cardholders must be proportional to the actual direct costs. Additional fees are only permitted if they are not directly related to the granting of a loan, such as acquisition processing fees or fees charged by the card network. Narrative scheme, mechanism of payment, card transactions in the Sharia system. The mechanism of payment card transactions in the Sharia system involves the flow of relationships among five parties. First, the bank as the card issuer issues a card to the customer based on certain eligibility criteria. Second, when the customer, cardholder, uses the card at a merchant's point of sale, POS, the transaction is routed through the acquiring system to the merchant's bank, acquirer. Third, the acquirer connects the transaction to the card network, such as Visa or MasterCard. Fourth, the card network verifies and facilitates the approval of the transaction quickly and securely. Fifth, once the transaction is approved, funds are credited to the merchant's account, and if the funds originate from the issuer, in the case of credit or debit cards, the cardholder is obliged to settle the amount. In the Shariah context, it is important to note that each relationship is characterized by a specific contract, a qat. The relationship between issuer and cardholder is a service contract at issuance and becomes a card loan contract when the issuer pays the merchant on behalf of the customer. The relationship between acquirer and merchant is a wakalah, agency contract, representing the merchant in processing transactions. The card network acts as a technical service provider and intermediary in transaction settlement. This scheme avoids riba by ensuring that every transaction adheres to the principles of justice, transparency, and the absence of profit from loans. AAOIFI recommends Shariah-compliant alternatives such as ujra-based, service fee cards, or credit cards based on the Tawarruq contract, which are strictly regulated to prevent deviation from Shariah principles.